AM 580, always streaming inside your WDBO app. For more than 30 years, the professionals at Certified Financial Group have been answering questions for listeners every week right here on WDBO's On the Money. They've become Central Florida's most listened to financial call-in program, and it's the only call-in program where all of the hosts are certified financial planner professionals. Joe Bert and Gary Abely joining us today, and they are one of the oldest and largest independent financial planning firms in the area. They have more than, I think it's over 400 years.
4 million years.
4 million years.
Yep.
Yes, the Tyrannosaurus Rex is the original certified financial planner with the group there, the Certified Financial Group. They have over 400 years of combined experience providing financial planning and asset management to Central Florida families and WDBO listeners right here on the Money. Joe, Gary, how are we doing today?
Good to be with you, Josh. Excuse me. This cold weather's getting to me. How about you? You like this cold weather?
I enjoy it. I enjoy
You
it.
do? You like it?
I love it.
What are you, nuts?
Well, I'm in short sleeves.
I
You're in a
can
leather
tell.
jacket over here, and we're indoors.
I'm still warming up. Anyway, excuse me again. Good to be with you. As Josh said in the introduction, we are here to take your calls, things that might be on your mind regarding your personal finances, decisions that you're trying to make regarding your IRA, 401k, long-term health care, reverse mortgages, real estate, insurance, annuities, all that stuff that Gary and I and the 15 other certified financial planners work with our clients, providing them retirement planning and investment management for a fee on Monday through Friday. But on Saturday morning, we are here for you absolutely free. So if you have anything that's on your mind regarding those or anything else I may not have mentioned, the good news for you is that the lines are absolutely wide open, and you could be first in line, make the line by picking up the phone and dialing these magic numbers.
844-580-9326 is the number to call, 844-580-WDBO, or you can send in your question via the open mic feature inside the WDBO app. Today's topic, what do studies show about timing the market and dollar cost averaging?
So tell us there, Mr. Abely.
Well, this is an interesting study I found in my email this past week from Charles Schwab. And it looked at 5 different investing styles. And I think we've run across all 5 of these, right?
I'm sure we have.
Number 1 is what they call Peter Perfect. He is somebody who has perfect timing. And I think Joe and I will hire anybody who can come to our office and help us with the perfect timing. It's impossible. But anyway.
So let's define Peter Perfect. What's he trying to do? Which means what?
So each of these were investing $2,000. They were given $2,000 at the beginning of each year for 20 years. And they looked at the results for, at the end of 20 years, the 20 years ended 2022, for a perfect timing person. What they call Ashley Action, which is as soon as she got her $2,000, she invested it immediately. You have Matthew Monthly, who said, well, I'm a little nervous right now. Let's put in, divide that 2,000 by 12, and let's put in that, I think it's 166 each
so
period.
It's dollar cost averaging.
Dollar cost averaging,
Okay.
Exactly. Then you've got Rosie Rotten, who had the worst timing. She ended up investing her money at the peak in each period, so one time at the height each year and over those 20 years. And then you had Larry Linger, who kept his money in cash because he was probably nervous about the market. And, of course, we know the winner is the one with perfect timing, right? We know that. However, and by the way, Schwab looked at 78 separate 20-year periods, and they found similar results in all of those periods. So this is, a pretty conclusive study. And what's interesting is for the perfect timer, they ended up with, at the end of 20 years, again, $2,000 a year for 20 years, with $173,000 and change. Call it $174,000.
So let me go back. So what did the perfect timer do? They got in right at the bottom?
That's exactly right. They put the $2,000 at the lowest point.
So they were able to determine the lowest point and said, I'm in now.
Exactly.
And then let it ride for 20 years.
Yes, and again, you're hired if you can do that for us over the next 20 years.
I thought that's what you do.
Yeah, right. I wish we had that luck. So what the fascinating thing is, the perfect timer ended up with $174,000. The action individual, just who put the money, invested it, didn't dollar cost average. They just invested it as soon as they got it. Actually had $161,000.
So difference
not far behind.
Difference of $13,000.
Difference of around $13,000 exactly. And then the person with really horrible timing this is kind of interesting too, actually had $142,000. So not terribly behind, right? And obviously the dollar cost averaging would have been in between the investing immediately and the bad timing. And of course, the person who stayed in cash had about a third of the money, right? They ended up with about $64,000 at the end of that 20-year period. And so the topic was, does market timing work? Well, of course it does if you can get it, but fewer than, 10% or so of managers are effective each and every year.
Consistently. That's the key.
Right.
You could be right sometimes, but you're not going to be right all the time.
Right, and when you're right sometimes, I think we know that four-letter word. It's called
luck. Right.
Right. So if you're lucky, you might get it, but you're not going to get it consistently over a 20-year period. What was interesting is, the dollar cost averaging, while it's behind immediately investing, it wasn't significantly behind. And what I say to clients who are kind of the Larry Lingers, if you're going to always try to wait for that perfect time, at least let's get started.
Exactly.
Get that money to work, even if we have to dollar cost average over 3 periods. 4 periods, the more conservative someone wants to be, maybe you go as far as 6 periods, but get that money invested right away.
Take that first step and get started.
Exactly.
And the difference isn't that great.
It is not great.
The point is doing something.
Well, and we say this all the time, and I think we have handouts that say time in the market makes us successful.
Right.
Timing the market, you just can't do it. No. So don't try. And I know a lot of folks, we just finished an election, right? And we have a new sheriff in town, and probably, 40 to 50% of the country is not excited about the new sheriff. And some of those folks have called us and said, well, I'm nervous about, this or that. I'm nervous about tariffs. I'm nervous about the deficit going up with not taxing Social Security and all of these campaign promises. And our job is to say, relax.
Right.
Maybe you cut down on the news a little bit, if you have a lot of anxiety, because sometimes information overload, kind of paralysis by analysis, right? You're paralyzed. You can't make any move at all when you're bombarded with information.
We've said time and time again, we're as much behavioral managers as we are investment managers.
That's right.
And it's your behavior that ends up blowing you up. It's making the wrong decision at the wrong time simply because your gut tells you something. My gut tells me this. How many people were concerned about the big recession that was coming? How much did we hear the R word for 2 years? It's coming, it's coming, it's coming. The end of the world is coming, the recession, get out of the market, sit on the sidelines and wait till things get better.
Exactly. We heard that all the time. Now, we should point out, though, we haven't had a bear market since 2009.
And we're due.
We are due. So that's 15 years. Mm-hmm. And on average, we get one about every 5.5 years. Right? And the average decline is around 34%. Mm-hmm. But we do not want to try to time it and say, well, we're going to get out now and we're going to get back in at a lower point. Because there's an old quote: the market can stay irrational longer than you can stay solvent. Right? don't try to make complete sense out of the market. Long term, it makes sense, but there's some short term, silliness. You passed out an article to all the planners over this past week, just talking about the Bitcoin and talking about how many are calling this market a little bit excessive. We're trading around 25 times. Prior earnings, trailing 12 months earnings. I just read an article from Bank of America, analysis by Hartnett at Bank of America saying froth is building in U.S. stocks. But we have to ignore all of these things. You're going to read these articles, and again, it's going to cause somebody to pull out and not stay the course. And that's so important, is to stay the course.
Right.
Yeah. So anyway,
and and the thing to keep in mind though is that because we manage our clients' portfolios, we take advantage of those opportunities by rebalancing.
Exactly.
That is the key, and using tax loss harvesting to get some bang for our buck from Uncle Sam, and moving on forward. So that's really what investment management is all about.
And let's give an example of that.
Sure.
The pandemic year, at one point, the S&P 500 index was down 34%.
Right.
Now, The year end for that year, we were up 16%. So there was actually a difference of 50% on one day versus another day. And if you got out at that low point, at the 34% down, that you're solidifying a loss. And
you lock that in.
Yeah, and you just, as you are closer and closer to retirement, you can't afford to make those mistakes.
This is why it's more and more important to allow some advisor that you trust to help guide you through those times. We take those calls. We call it we're talking them off the ledge, right?
Exactly, and it's because of our discipline, and because of working with people over the years that helps us give people evidence-based information that suggests this is what you're doing or what you're contemplating doing would be a mistake.
Right.
So,
and that doesn't mean, of course, when the market is down, you sell, you're going to lose.
Right.
But it's not a loss until you've sold. And that's why, of course, you want diversification.
Right.
That's why you want to understand what your cash flow is. That's why you don't want to sell when things are down, because the only time you lose is when you have to sell. And that's why having a plan and knowing what your cash flow is going to be, how to manage those things. And that's what
the whole rebalancing, right?
Exactly.
When the market was down 10%, a 60-40 portfolio was off of its target 5%. And people rebalance at different levels. You might be 5% off target. You might be 10% off your target. But the key is having a disciplined plan, so when the market goes down, you are taking advantage of it. In this case, you'd be selling some of your bonds or fixed income investments and buying more stocks to take advantage when they're down.
Right.
And conversely, though, the market is volatile, right? We think about the year we just had. People don't consider an up year greater than 20% as a volatile year because it went up.
Right.
But that's volatile too.
Exactly.
The long-term average is 8%.
Right.
So, volatility works in both directions.
Right.
Yeah.
All right, here's some bumper music there. Josh, take it away.
Thank you so much. If you want to join the conversation, 844-580-9326, 844-580 WDBO. Joe Bert and Gary Abely guiding us through another great episode of On the Money here on WDBO. Send an open mic in if you want to leave an on-demand question for the show host. Go ahead and open up the WDBO app, click the open mic button, and send it on in. You're listening to On the Money, where we're planning tomorrow
Today
with the Certified Financial Group.
This hour was
For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're a certified financial group, but we're planning tomorrow, today. Our fiduciary approach of providing retirement planning and investment management for a fee seems to resonate with our clients. But don't take my word for it.
I knew a gentleman that I worked with who had come to Certified Financial Group.
A friend of mine recommended them, and they were totally correct how good they are.
I had heard from somebody else that it was the best one in town.
I've sent several of my teacher friends here.
We're a certified financial group, but we're planning tomorrow, today. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're a certified financial group, but we're planning tomorrow, today. Black Monday, the dot-com bust, 9/11, and now two wars. We've pretty much seen it all. Acting as fiduciaries, our CFP professionals have been a steady hand guiding our clients to and through their retirement years.
No reason to be worried about anything.
Stay the course. You stay the course, and you get there.
I don't have to worry about it like I know a lot of people look at it every day. I don't have to do that with the team here at Certified Financial Group.
We're a certified financial group, but we're planning tomorrow, today. Are you tired of trying to reach your advisor through a call center and being put on hold for 20 minutes? That's why we don't use one, and our clients seem to appreciate the personal touch.
They always answer my questions and really care about what's going on with me.
You can trust what they say, and they do what they say, and it gives you a comfort feeling it's hard to find in the world today.
Waiting for you to call almost. You almost feel like that.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
Gary Abely and Joe Bert, a couple of certified financial planners with the Certified Financial Group here in Central Florida. Taking your calls today live, 844-580-9326, 844-580-WDBO, or send in your open mic using that free WDBO app. What do you say we head to a text question, guys?
Let's do it.
Sounds
All
good.
right. Nancy wants to know. Nancy says, I feel I've missed the boat on crypto investing. Is it too late to get in now?
Well, there's a lot of talk about cryptos, certainly since Donald Trump was reelected and all the
hitting 100,000
of Bitcoin. Yes. So, what do you think there, Gary?
Well, have you missed the boat? I don't think any of us here minds a client speculating with a small percentage of their money. And by speculating, I mean investing in something that does not produce an income. Gold, for example, is a commodity that does not produce any income. Obviously, Bitcoin is a cryptocurrency that does not produce an income. So when you're buying these items, you're expecting that somebody else in the future will be willing to pay a higher amount than you paid. And so it's difficult. I don't particularly like investing in those items because I want to see cash flow, because ultimately if an investment is generating income, they can share that income in the form of dividends to me. And that's sort of the Warren Buffett way of investing, right? Focusing on cash flow, value-oriented companies, and Bitcoin or cryptocurrency doesn't fill that gap.
Yeah, all you're doing is really looking for pure growth. And when you look at investing, the two ends of the spectrum are income and growth, and they're mutually exclusive. You cannot get the maximum amount of income or the I take that back. You can invest purely for income or purely for growth, but you can't get the maximum growth and maximum income out of the same investment.
Exactly.
It's mutually exclusive. So what? And generally, your growth investments have more risk attached to them.
Yeah, and we need to remember that when the Bitcoin had hit another milestone and people were all excited, it then dropped by 3/4, right? Dropped by, I think, 76% from its peak.
Right.
So there's, you have to say, well, what is the use of this, right? I think, some appeal perhaps to Bitcoin is the fact that there is a limited supply, right? I would be worried.
And there is no tangible Bitcoin. You can't put one in your pocket.
Exactly, right. So it's interesting. It's not really used for transaction. Now there are other currencies, digital currencies that could be better used for exchange. Ethereum would be one that's talked about a lot. But I think it's just important to say it's when people start getting excited and everybody's jumping on board, that's typically when we see the peaks, right? It's that herd mentality, of feeling like the fear of missing out, right? FOMO. And that sometimes will drive additional appreciation. But at some point, people look at fundamentals and say, okay, what exactly is this, that I've got? What am I receiving here? This is something that doesn't produce an income. It's not readily used as exchange, or very limited use for that, and oftentimes in criminal endeavors. So I would be leery. My own advice would be leery. And what percentage of a portfolio, Joe, would you say somebody should put into those types of speculative investments if they really want to?
Certainly no more than 5%.
Okay, and I was going to say, I guess I'm more conservative. I was going to say
3?
No more than 2.
2?
But I would personally, I wouldn't put any percentage in it in my own portfolio. But if somebody was really, of course, it's a different asset, right? So it is a diversifier of some sort, right? It's likely not to correlate with your other investments.
Yep. I hear the bumper music. Josh, take it away.
If you want to join the conversation, 844-580-9326 is the number to call, 844-580-WDBO. Send in your question using the free WDBO app. The open mic feature inside can be found in the bottom right-hand corner. Go ahead, click it, send in your question, and we'll play it back live on the air as if you're sitting right next to me. You're listening to On the Money, where we're planning tomorrow.
Today.
With the Certified Financial Group.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is most people think that their butcher is a dietitian. So when one of your moms or dads or friends calls the broker and says, I got 200 grand, I sold a little piece of property, or I got some inheritance, what should I do with it? They're going in thinking they're talking to a dietitian, and they're really talking to Lou the butcher.
What is a fiduciary? When it comes to investing, a fiduciary is legally required to act in your best interest. For 40 years, planners at Certified Financial Group have been guiding our local clients toward financial peace of mind. The rest of the world is still catching up, but our team of certified financial planners are the local, experienced fiduciaries you can trust. Certified Financial Group are your Central Florida planners. Call us today.
40 years ago, I had a dream of building the best personal financial consulting firm in Central Florida. Now, with 14 certified financial planners acting as fiduciaries, I believe we're there. But don't take my word for it.
As we approach retirement, we have the freedom of choice.
Peace of mind that we now have. That's everything to us.
The people that work here are honest and caring, and I feel like I can go to sleep at night.
So schedule your no-obligation visit today at financialgroup.com, or we're planning tomorrow, today. For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're a certified financial group, but we're planning tomorrow, today. Our fiduciary approach of providing retirement planning and investment management for a fee seems to resonate with our clients. But don't take my word for it.
I knew a gentleman that I worked with who had come to Certified Financial Group.
A friend of mine recommended them, and they were totally correct how good they are.
I had heard from somebody else that it was the best one in town.
I've sent several of my teacher friends here.
We're a certified financial group, but we're planning tomorrow, today. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're a certified financial group, but we're planning tomorrow, today. Black Monday, the dot-com bust, 9/11, and now
On the Money here on WDBO AM 580 and always streaming inside your WDBO app. If you want to join the conversation, we got some open lines. 844-580-9326 is the number to call. 844-580-WDBO, or send in your open mic using that free WDBO app. Joe Bert and Gary Abely in studio today. If you want to talk to Charles Curry off the air, he's standing by ready to take your calls. If your question or comment or your solution maybe is a little bit more sensitive, or you want to use specific numbers, that's where Charles Curry can come in, get your question answered by the same team at Certified Financial Group off the air. That number is 407-869-9800. I'll say that again, 407-869-9800. And another option you can utilize these great resources at the Certified Financial Group is actually you can head on down to the offices. Isn't that right, Joe?
You can do that. Dave Bellachristian today is having a workshop, and next Saturday we're doing another one, very popular one, about the choices regarding Social Security. As I say in the ad, Social Security can tell you what your options are, but they cannot tell you or will not tell you what's best for you and your family. And there's a myriad of decisions that you have to make. Should I take the early retirement? Should I wait till 70? Should I take it to full retirement? Then you have to consider widow benefits, survivor benefits, dependent benefits, and all that other stuff that goes into it. So Dave will be covering that next Saturday at our offices here at 10 o'clock. If you want to get in on that, seats fill up fast. Go to our website, financialgroup.com. That's financialgroup.com. Click on events, and you can reserve your seats right there. All right, got another text question I saw floated in. Josh, take it away.
You got it. Richard says, I will be receiving an inheritance soon from my mother who recently passed. She's always invested her and Dad's money conservatively, and I want to honor that. I see CD rates are about 1% less than last year. Are bonds too risky? I'm 45 years old, if that helps.
Well, it does help, but...
it does help. And, so to answer the question, are bonds too risky? Well, I will say this, the aggregate bond market over the last 10, 20 years has done under 3%, right? It's not been a great time period for bonds, and largely that was due to 2022 when the bond market had one of its worst year, actually the worst year since the Civil War, so a horrible year. I appreciate when somebody says they want to honor someone's investment style, but I would point out that obviously the parents are older.
Right.
He's in his mid-40s, and just because they were conservative, it was likely due to their age. So this would be a great example of someone we would love to bring into the office and really spend some time educating that individual on asset allocation. And one thing I always would say to somebody, and what was his age again? Was
45.
It 45? 45, okay. I would always say the minimum that you want to have in equities, meaning growth investments, would be 110 less your age, right? So in this case, we would expect the person to be moderate based on their age.
65%.
65% in equity. So I would start there and suggest probably your parents were conservative with their money because of their age. And let's assume that parents were, say, 70. They probably should have still had about 40% of their money in stocks because people live until their mid-90s, right?
Mm-hmm.
Now, we don't know the age of the parent's death, but I think one of the biggest mistakes people make, and correct me if I'm wrong, Joe, is not being aggressive enough and not realizing the likelihood of living into your 90s.
Right.
I mean, it's...
Yeah. Time is a great asset, and if you don't use it, you lose it, and once it's gone, you can never go back and recover. And I think, of course, the first question we'd have for this individual, all right, you're 45 years old, you're inheriting this money, when are you going to need to tap into it? What's your time horizon?
Right.
The longer your time horizon, the more aggressive you need to be and should be, because time is a great healer, and you will recover. So, but if you need the money in the next year, 2 years, 3 years, or 5 years, then you need to be more conservative. But if you have a long time horizon at age 45, you generally have a long time horizon.
That's right. And there's a handout I love to show to prospective clients or even clients, which goes to the period 1992 through 2012.
Mm-hmm.
And why I like that 20-year period in particular, one, it doesn't include all of these great years we've just recently had, but it includes two of our worst bear markets, right? We had the dot-com bust, where the S&P from peak to trough dropped 49%, and then it also includes the financial recession for the period ended March of 2009, where we dropped by 57%,
right.
During multiple year period. But what I like about that, it talks about what was the best year and what was the worst year in that 20-year period. And they're extremely symmetrical. The best year was up 37% and change,
mm-hmm.
and the worst year was down 37% change. Of course, we know that was 2008.
Right.
We remember that well. And then it goes into the best, worst 3, best,
mm-hmm.
worst 5, and it goes out to 15 years.
Mm-hmm.
And certainly somebody 45 has 15 years. And what's interesting, I can't remember the best, but I remember the worst. And the worst 15-year period, which of course would be the 15 years ended March, I think it was March 9th.
March 9th,
yeah, we remember that date.
Mm-hmm.
Yeah, that was the bottom of the financial recession, and you still had more than a positive 4% return during that time. So it gets back to the start of the show where we had, what was the worst timer? Can't remember her name now.
Yeah.
But anyway, that individual who with the worst timing still during that period of time would have had more higher earnings than you would have had probably in bonds during that same time frame.
Right.
So again, it gets back to time in the market. But back to the question, we would really want to counsel that person, do a financial plan for them, look at their cash flow needs. Certainly, we were talking off air, and when we were talking a little bit more about Bitcoin. Well, one of our goals for clients is to have them reach their financial goals with as little volatility as possible.
Exactly.
And, when you start interjecting speculative investments, you're adding risk, you're adding volatility, which is, counter to what most people want who come and see us.
Right.
So our goal would be to look at a cash flow and, number one, see if he needs growth. Maybe he has children, maybe he doesn't. But certainly if he has children, he might want to be thinking of growth of assets for the children if this inheritance puts him above what he needs. Right. So there's a lot that goes into planning. It really is.
And then, if you have children, then what are the needs of those children? Do we have college? Do we have weddings?
Exactly.
And that's where planning comes in. So how much do we set aside for immediate needs and how much for long-term needs? You divvy it up accordingly. It's not just taking the money and putting it in CDs that I got 1% more than my mom and dad and I'm doing great.
Yeah, that's exactly right.
And that's what, unfortunately,
now
do.
just to clarify, because I don't want people to think that we're trying to get people outside of their risk tolerance either. We do have people complete an award-winning risk assessment questionnaire, and it will indicate whether somebody is conservative, moderate, moderately aggressive, or aggressive. Now, our job isn't to take somebody who's moderately conservative and make them moderate, right? Our job is to educate them and explain the volatility of the market, and to explain volatility is normal. I mean, if the difference between the peak and the trough of the last 43 years is 27% on average, which is pretty volatile, right? And so once people, I think, once they get educated, I think then they change their perception of risk, right? Because the longer you're invested, obviously the greater the return and the lower the volatility, right? It's that short-term volatility that really scares people, I think.
Yeah, it's the volatility that can destroy you, I think, psychologically.
Emotionally.
And that's where people make mistakes. They get on the ledge and they jump off and don't have a parachute.
How many people have you visited with, Joe, that come into our office and say, I made a mistake and I sold in 2008 because I was worried when Bear Stearns went under and this, and I was worried the end of the world was here. And we all have charts in our office that show all of the really horrible world events and the timing of those and how the market ignores them, because what are they focused on? They're focused on the positive free cash flow that the companies are generated. And that's generally what makes markets move, is earnings and cash flow.
Yep. So don't know if we answered that question, but we gave you our own feelings about what you should do when you're 45 and you inherit mom and dad's money.
Exactly.
So another text question there, Josh.
Certainly. Brian asked, a while ago, someone on your show talked about buffered ETFs.
Oh, yeah.
Would you mind covering this again, as I'm nervous about world events right now?
Well, there's always something going on in the world, it seems. And so buffered ETFs came out maybe as a panacea for that. Gary?
Yeah, and it's interesting. So let's explain what a buffered ETF is. Well, first, what's an ETF? An ETF is an exchange-traded fund. So it's a fund that trades on the New York Stock Exchange between 9:30 and 4 o'clock.
Now, the difference between that and a mutual fund is?
So a mutual fund gets valued at the end of the day and has a net asset value. An ETF's value at the end of the day is its last trade. Right? It's like, there's a bid and ask price on a stock, and it's the same with an exchange-traded fund.
It's like a stock, but it's a stock made up of a whole bunch of stocks.
That's exactly right. Yes. So what a buffered ETF does is you have a company that uses options to give a defined outcome. And that defined outcome, as an example, might be if you buy in the ETF, and it's usually the best time to buy is around the third Friday of the month when options expiration occurs, right? And so they put this in place during that time, and it works like you have a upside of 12%, maybe 15%, depending on the timing and depending on what your downside buffer is. And the downside buffer might also be somewhere between 10 to 15%. So, for example, if the S&P 500, and they have ETFs on a variety of indexes, not just the S&P 500, it might be on QQQ, the NASDAQ, several different options, the Dow Jones. But if the market went up 30%, well, you'd be capped at that 12 to 15%. Okay. However, if the market went down 30%, you would have a buffer of maybe 10 to 12%, so you would only lose 20%. Or maybe 18%. So it gives you a range of possible outcomes. And where somebody might like that is if they were nervous. And I guess I would put it this way. If the Larry Linger in that example in the beginning, the person who stayed in cash for 20 years, would a buffered ETF be better than staying in cash? Well, quite likely, right? So because but ultimately, out of the last 95 years or so, we've had, I think it's 38 years that we've had a return greater than 20%. Okay, I might be off by a year or two, but that's the general gist. And so the market is volatile on the up and down side, and when you cap your returns, this would not be a good long-term strategy. And if you're doing it as a short-term strategy, what are you doing? You're timing the market, which we said earlier doesn't work, right? Unless you're one of those geniuses who can do it, and please send us your resume. So,
but I would say it's probably one step away from being in cash.
Yeah, I guess so. The buffered ETFs one step.
Well,
tell me why.
Well, you have a higher upside than just sitting in cash. That's
okay. I misunderstood you. Yes, it would definitely be better.
Yes. Right. All right, Josh, take it away.
If you want to call in, 844-580-9326. If you want to call off the air, Charles Curry standing by, 407-869-9800. 407-869-9800. Or send in your question using the WDBO app, the open mic feature inside. Send in your 15 to 20 seconds comment or question or compliment for these wonderful hosts at the Certified Financial Group. You are listening to On the Money, where we're helping you plan tomorrow
today
with the Certified Financial Group.
This hour was 2 wars. We've pretty much seen it all. Acting as fiduciaries, our CFP professionals have been a steady hand guiding our clients to and through their retirement years.
No reason to be worried about anything.
Stay the course. You stay the course, and you get there.
I don't have to worry about it. Like I know a lot of people look at it every day. I don't have to do that with the team here at Certified Financial Group.
We're Certified Financial Group, where we're planning tomorrow, today. Are you tired of trying to reach your advisor through a call center and being put on hold for 20 minutes? That's why we don't use one, and our clients seem to appreciate the personal touch.
They always answer my questions and really care about what's going on with me.
You can trust what they say, and they do what they say, and it gives you a comfort feeling it's hard to find in the world today.
Waiting for you to call almost. You almost feel like that.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite. Marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact
To and through retirement. If you want to join the conversation, 844-580-9326. But with just about 5 minutes left, the number you may want to write down is the number to Charles Curdy inside the office at Certified Financial Group, 407-869-9800. 407-869-9800. Just had Thanksgiving recently, guys, and I know that means, the year is almost over, and so we should try and get our affairs in order before Uncle Sam starts making some changes.
Time to think about it before 12/31. So Gary has some year-end tax planning ideas. Gary?
Well, I do, and first I'm going to say I think I have the best $50 you can spend before the end of the year, and that is on tax software. And later today, I'm going to be in the office running through lots of different tax scenarios. I have Sally sample and different, single people in my tax software, joint people, joint filers. And what I'm looking to do is three things before the end of the year. First, I'm looking at my client accounts to see if I can harvest any losses. Now, what that means is if I have any investments that are trading at losses in taxable accounts, so these would be non-retirement accounts, I may want to take that loss and buy something similar, not the same, because there's something called a 30-day wash rule where you can't buy the same thing back within 30 days.
Well, you can, but you don't get the loss.
Well, you don't, right. The loss gets suspended, right. So harvesting losses is something to take a look at. Unfortunately, or fortunately, depending on how you want to look at it, there's very little of that because the market has been so good. But we also want to recognize gains where we can at a 0% tax bracket.
Right.
So we have a lot of clients that retire early, and they don't have to take money out of their IRAs until maybe age 73 or 75, depending on their age. And that's the required minimum distribution ages currently. And if they're in the 0, 10, or 12% tax bracket, the capital gains rate for long-term capital gains is actually zero.
Zero. Yep.
So, I've shared this, year-end in the past, but if you're sitting on, say, Apple, where you have a $50,000 gain, and your income otherwise is $50,000 without that gain, you can actually recognize that gain and not pay any taxes. Now, unlike the wash rule, because this is a gain, if you still wanted to own your apple, you could buy it back seconds later, right? So you would sell apple, recognize the gain, pay no taxes on the gain, but reset your cost basis, right, by the $60,000 or whatever. The other thing looking to do is calculate what the cost would be for Roth conversions this time of year. Same idea. If we have a client with a large IRA account and we know they're going to be in the 22 or 28% or higher brackets in the future, we want to make sure we're using up the lower brackets right now. And we can do that by creating income, by converting some of their IRAs to Roth IRAs, and that can have a phenomenal long-term tax benefit. So these are some of the things that you want to use tax software for, though, because there's a lot of unintended consequences when you start creating additional income. For example, you might be in a situation where your Social Security is not taxable, but when you do a Roth conversion, up to 85% of that may become taxable, right? So you really, I prefer using software so I can say to a client, here's the financial impact if we do a $20,000 or a $40,000 Roth conversion. Here's the dollar amount, and here's why I recommend it. And so those are the kind of things we really like to do at your end.
And while you're doing that, I'm sure our clients and you don't forget that the mutual funds distribute their capital gains at the end of the year.
That's right.
So that could impact your income. So before you start doing a lot of repositioning, you have to determine what kind of capital gains am I going to be getting from those mutual funds. And as a reminder, we mentioned this last week, and we've sent a notice out to all of our clients at the end of the year, just a reminder that you will see your share price of your mutual funds decrease. Because when those mutual funds distribute their gains, the share price decreases, but then you flip around and the next day you're buying more shares. It's a wash. You're not up or down, but it is generating income, so you got to be careful about that.
That's right. And sometimes custodians will adjust the share price and not the number of shares for a short period of time. It looks like you've lost money, but you really haven't. Just give it a moment and log back in on the next day, and it'll all work out. So.
Well, it's good being with you today, Josh. As always, just a reminder, we've got workshops coming up next Saturday on planning for Social Security. Go to our website, financialgroup.com. That's financialgroup.com. You can make a reservation right there.
Thank you so much. If you want to reach out to Charles Curry, 407-869-9800. You've listened to On the Money, where we're planning tomorrow
today
with the Certified Financial Group.